Evan Greenfield, Managing Director for ESG in the private equity team at British Columbia Investment Management. Welcome to Sustainable Investors Asset Owner Interview Series.
Thanks so much, Chris. That introduction always sounds better with a British accent, so I appreciate that immensely.
And we're here to discuss the recent academic paper, ESG Value Creation in Private Equity. But before we do, Evan, please provide us with a little bit more information about your role and the role of private equity at your firm.
Chris, thank you immensely for having us on today. It's a great privilege to be on this program, as I've had the opportunity to watch several other episodes, and I'm with some really outstanding folks in the asset owner community. So thank you. But by way of introduction, BCI is the Public Pension Program of British Columbia, Canada. We oversee approximately $220 billion in assets across 32 different pension programs. And I am in the private equity asset class, where we oversee approximately $25 billion in assets. We are focused in private equity with those assets in investing in underlying GPs as a limited partner with about half of the assets, and the other half is allocated to direct investments, co-investments, which we generally do alongside our GP partners. We're a global firm. Private equity invests on a global basis. We focus on five main sub-verticals: business, consumer services, financial services, industrials, TMT, healthcare, and industrials. I sit within private equity, and I help oversee ESG integration in the private equity domain. And we're steadfastly focused on ensuring that we leverage ESG and sustainability for economic return, as our ultimate fiduciary obligation is to achieve risk-adjusted enhanced returns for our members who are pensioners of British Columbia.
Fantastic. Okay, well, let's dive into the big questions. I mean, from all the way from entry to exit is your approach. So throughout all those different stages, how do you ensure that those ESG factors are incorporated into your thinking and your processes at every stage?
Well, Chris, it's quite interesting. If I like to make the analogy, if you remember the movie from the mid-90s, Jerry Maguire, where it was about show me the money. And so that is a key component of how we leverage ESG, is to show the money. And that certainly translates into a great deal of attention and interest in the topic. Over time, I've been asked to develop a framework associated with that approach. And I said it's simple. We try to leverage ESG for enhanced risk-adjusted returns. But to answer your question, we did develop a framework which is predicated on the three main parts of a private equity investment process. The first part of that is the investment diligence stage. And from an ESG lens, we're primarily focused on understanding the material financial risk associated with that investment from an ESG perspective, both understanding the company and the industry, but quite importantly, understanding the material ESG factors for the company into itself. From that vantage point, we're then able to ascertain what we should do with that information from both an operational and transactional standpoint. Should we look at reducing purchase price because of the ESG risks that we may have identified? Are there reps and warranty insurance that we should look into? Are there post-close operational enhancements that we will look to deploy given the identified ESG risk? Or could we potentially step away from the transaction? So the first stage in terms of investment diligence is primarily largely focused on ascertaining the ESG risk. But we're also spending a fair amount of time as well determining and working with management of a potential investment target to discuss opportunities emanating from ESG, to set the culture and the tone early that we look at ESG as a means of opportunities as well as risk reduction. When we get into the next phase of the investment, to the extent that the opportunity comes to close and fruition, it's that in-between period between entrance and exit, which is value creation and operational improvement. We're still spending an inordinate amount of time ascertaining the ESG risk of the company. You certainly have a much better understanding of your underlying portfolio company post-diligence than you did prior to diligence. And more so, some of these risks can evolve and change over time. So we're spending a fair amount of time still continuously assessing these risks and determining what we should do to reduce them. At this stage, the risk reduction is not transactional. We've lost that opportunity. It's purely operational. We're also spending a significant amount of resources and intention to ascertaining the value creation drivers emanating from sustainability. How can we leverage the macro tailwinds behind sustainability, behind climate transition, to ensure that the portfolio company is pursuing product innovation, supply chain diversification, operational improvement and enhancement. And most importantly, during this stage, we're tying those elements to dollars and cents, financial outputs and financial linkages. How could we leverage these factors for EBITDA growth, margin expansion, capital efficiency, and ultimately enhancement value at exit? What is immensely critical at this stage is cultivating strong relationships with management. We need to ensure that management buys in and understands the vision, understands the implications and the opportunities emanating from ESG and sustainability, and are able to deploy it. We are not members of management. We are there to provide guidance, to provide education, to provide assistance. But the day-to-day operation of the business is members of management, from the senior members of management to the middle tiers to the most junior members of the organization. So in this stage, cultivating a strong relationship with management is paramount. And finally, at the exit stage, we're looking to ensure that ESG is clearly a core part of the competitive advantages and differentiation of the company that's been established during the value creation stage, and that is expressed and established in the materials around an exit, whether it's in the management presentation, the confidential investment memorandum. We want to ensure that ESG has become such a priority and importance of the organization, emanating from competitive advantage, competitive differentiation, product optimization, supply chain diversification, that's quantified, and that becomes slide 3 of a SIM as opposed to buried in the appendix. We have a view that those companies that are able to establish their ESG and sustainability credentials will likely trade at a premium, because there is a demonstration of the economic viability, the adaptability, the resilience of that company that should put it into much better, more compelling light in the exit process. So that's how we look to approach ESG across the board, across the investment stage process. But I will point out, Chris, that depending on the company, these factors will change. There's no one-size-fits-all approach. It's very much customized to understanding the company, to understand the company's strategy, and to ensure that there is an economic advantage and linkages emanating from sustainability.
Understood. I mean, under that, there's no one-size-fits-all umbrella, I suppose, is one of the issues that you referred to at the top, in that you invest in different ways. And so how does that kind of ownership relationship, whether it's kind of direct or slightly more kind of diluted, how does that affect your approach?
Well, the private equity asset class writ large has a compelling advantage, in addition to the private market asset classes, relative to some of the other verticals, in the respects that we are generally significant minority or majority ownership. We generally have significant governance rights, board seats. We have the ability to engage with management on a weekly, if not daily basis. That allows us to have a much more holistic, comprehensive engagement on ESG factors. The less governance you have, the less economics you have, it becomes more challenging to effectuate that change. But it all starts with having the view that ESG can lend to an economic advantage, in establishing those principles to management so they buy in and they understand that vision. ESG should be treated no differently than any other lever of value creation, whether that's digitization, distribution, branding, marketing, etc. There needs to be a clear case for return. So when you have less ownership, less governance, less ability to effectuate change, you need to make that case a lot harder, and you need to ensure that you're having much more active dialogue with management. But we have the great fortune in the asset class that we're in that we have very effective tools, very effective means to have dialogue with management, and they generally, given our shareholding and our governance, they generally need to call us back. And what we want to ensure is that when they do engage on the topic of ESG, we move the dialogue from something that may have been perceived as an administrative exercise, a cost center, to an area of strong value creation, which is incumbent that we present case examples and case studies in throughout the portfolio to demonstrate to management the potential of sustainability. What we found is that irrespective of political viewpoint of management or ideological viewpoint, when you're able to tie the economic value attributable to ESG to enhancement of management's management incentive program, it quickly gets interest and quickly gets following with the organization. So our ultimate arbitrator is the financial lens and is the business viewpoint to ensure that ESG is a topic that management understands and that management executes and deploys because it's a core part of strategy that has a significant amount of economic benefit.
When you're investing as through the kind of private equity channel, clearly you are closer, most typically, to the portfolio companies than in the public markets. But you're also you're still relying to a certain extent on your asset management partners who are clearly providing support and insight and services. What are you looking for in terms of the kind of ESG related expertise capabilities of those asset management partners?
Sure. It is a great question. So, as I said, the portfolio is divided amongst investment as an LP into general partners, private equity firms throughout the world, as well as direct investments, which are generally alongside a GP partner. When we're looking at diligence or re-upping in a GP, it's a different relationship. We don't have those same governance that you may have in the direct portfolio company of being on the board. You may be on the LPAC, but you want to ensure that you're using your ability to influence, that we are educating our GPs in a means of attributing significant value to a portfolio, to an investment from this ESG lens. And so it's education, it's knowledge, it's part and parcel in many respects why we put together this white paper in the respects of educating our GPs in a more evolved approach to leveraging sustainability. But it's not just engaging with the ESG teams at these organizations, it's engaging with their operating partners as well as engaging with investment professionals such that they understand the economic value. I've yet to meet a GP or a management company that is not interested in enhancing risk-adjusted returns, and we demonstrate holistically and comprehensively and fulsomely the advantages of ESG integration into a portfolio.
Mm-hmm. Mm-hmm. Okay. Now, also, there's clearly there are good examples in the white paper about how you very successfully identified those connections between ESG factors and the levers of value creation. But I can imagine that that's not always easy, or as you say, similar across portfolio companies. Where have the kind of biggest difficulties or that you faced there?
That's a great question, Chris. And as we've established earlier, this is not a one-size-fits-all approach or a cookie-cutter approach. It's very important to ensure that before we do anything from an ESG perspective and engagement, that we have a clear understanding of the underlying company. So how I like to approach it is to meet with management and to talk about everything but ESG, to talk about their backgrounds, to talk about how they view the company, to talk about the challenges, the opportunities, their strategic advantages, their barriers for entry, their competitive position. From that information, we then try to assess and appreciate how we can leverage some of these macro tailwinds behind sustainability and climate to develop products or solutions for their underlying clients that they may not have thought of, to figure out how we can have operational enhancement and operational improvement that we would ascribe to sustainability, whereas others may just ascribe it to operational enhancement. And we have been able to successfully deploy this in any industry, any geography, any scale and stage of company in a holistic approach. But what is paramount is this, is that we need to demonstrate the economic return, the economic potential of engaging in an ESG initiative, both because there may be cost associated, as well as there may be administrative time, management time and attention and discipline. If that cost or management time and discipline has to be taken from another area that has higher return on investment, by all means, that other area should be pursued relative to ESG. But what we're finding time and time again is that ESG integration initiatives offering compelling ROI for each of the portfolio companies.
So does this mean that you don't necessarily that your ESG-led approach doesn't necessarily kind of mean that you impact asset allocation, for example, in terms of bias towards or against different sectors or industries or geographies?
Great question. Our mandate is to represent our 32 different pension plans to enhance risk-adjusted return for their underlying members, the pensioners of British Columbia. That's our mandate, full stop. That's our fiduciary obligation and our fiduciary duty. So we don't evoke on a exclusionary screening type of approach. We are not taking one sector versus the other sector because there is some ascribed societal value associated with that sector. We're looking across the board, across all of the sectors where we have subject matter expertise emanating from our investment professionals, and we're looking to invest in the opportunities that have the most significant risk-adjusted return as possible. ESG is not an arbiter of whether we should invest in a company or not. What we are an arbitrator of is the risk from an ESG lens of investing in that opportunity, how we can mitigate that risk, and then how we can pursue areas for value creation that have clear, tangible financial returns and economic linkages in dollars and cents. So it's an approach that has worked exceptionally well for our portfolio, where we see the potential for significant enhancement of returns that are attributable to sustainability.
Now, I'm not sure if you would describe this as a bottom-up approach, but it's very much kind of case by case, looking at taking each investment as it comes. How does I was wondering how it complements portfolio level sustainability objectives, if indeed that's how you work.
We look to sustainability through the financial lens as the primary objective. But with that said, there are significant societal and environmental outcomes that is a byproduct of that financial lens. So again, our fiduciary obligation is enhanced risk-adjusted returns for the pensioners in British Columbia. But as a wonderful outgrowth of that intentionality is societal and economic returns that are in concert with one another as opposed to in conflict. So as we present in the paper a number of case studies and examples that demonstrate the economic return, but there's significant societal benefit that accrues as a result of that as well. The reason why that's not the primary objective is because we see such opportunity when we arbitrate through that financial lens as the starting point, and then has the ancillary benefit accrue from the societal outcomes and the societal interest. But they certainly go hand in hand throughout the process.
Mm. Now, I wanted to bring you to the question of exits to your private equity investments. It seems clear that for a lot of purchasers that sustainability factors are increasingly on the agenda. But what's your experience of how that differs from different types of exit?
Well, again, if you can tie competitive advantage and economic gain to sustainability, it becomes a core part of your exit thesis for the next purchaser of that asset. And irrespective of whether that asset is being traded to another private equity fund in a financial transaction or a sponsor or to a strategic, to a corporate, or if that company is listing, we recognize that that next buyer will potentially hold that asset indefinitely if it's a strategic buyer or if it's a financial buyer for potentially the next 5 to 7 years. So we see that these elements are evolving over time. Sustainability changes and evolves. The same aspect with climate transition. So we again go back to the guiding star that sustainability needs to demonstrate financial return, financial capabilities. And if it becomes a core part of strategy, that becomes a core part of the exit thesis for the next potential buyer.
Okay, okay. Now, clearly, you've, as the paper shows, there's a lot of excellent kind of case studies, and there's much work behind the themes and the recommendations. How do you expect your own processes to evolve, having got to this advanced stage?
Well, I think there's several aspects. So one is that there's been this great debate as to what is ESG. And many of the challenges that we face in the industry is a definitional challenge. That ESG means very different things to many different people. So we did a survey of 20 different heads of ESG at 20 different alternative asset managers. We said, what is your definition of ESG? What we received back is 20 different definitions of ESG. So it is very challenging to ask investment professionals to integrate ESG or to ask management team members to integrate ESG when the so-called experts don't have consensus as to what it is. So we have set to define ESG purposely as a collection of issues that have gained societal importance and therefore is important to business and very relevant to our portfolio companies. As you heard in that definition, I didn't define the acronym. I didn't mention environmental, social, or governance, but a collection of issues that have gained societal importance. What we need to ensure is that this next evolution of ESG, and by the way, ESG is a recent integration in the capital markets. It served as an outgrowth to the financial crisis in many respects of 2008, has largely been the purview of the public markets, has been adopted and integrated in the private equity markets, potentially at scale in the last 5 or so years. So it's all relatively new. So this is evolving. We're looking collectively as an industry to experiment. If things work, let's educate each other. If they don't work, let's educate each other that it didn't work and move on. And we've gotten significant feedback from portfolio companies, from GPs alike, and other asset owners that ESG has largely been the domain of reporting. And it's reporting on information that may not be material and is causing a significant amount of administrative oversight of these portfolio companies. What we've tried to evolve is to leverage ESG for economic return that is quantified in dollars and cents, which is why we put forth this publication, because we wanted to highlight to the capital markets community, particularly those in private equity, irrespective of ESG is a stated intention or not, for those that are looking to enhance performance, that you can enhance performance emanating from sustainability integration as highlighted by the case studies that we gave forth, that we provided financial analysis and dollars and cents outcomes on. So this next stage is owning this narrative, taking back the narrative around ESG, but it's a area of great responsibility because we need to demonstrate and continue to demonstrate not only here at BCI Private Equity, but our underlying GPs, the GPs across the ecosystem, other asset owners, that this can in fact be leveraged for one of the last domains of great wide open space in value creation in private equity, that we can set the standards today as opposed to allowing others to define and set the standards for us.
And presumably you'd expect that this taking back of the narrative to also help with perhaps an understanding amongst members and beneficiaries of the reasons why ESG is so important to the investment process of their pension funds.
Well, Chris, you said it better than I did, 100%. Ultimately, again, our focus is on enhanced risk-adjusted returns for the pensioners of British Columbia. It is a very important work. It is work that we take very seriously. And if we're able to leverage these characteristics for value creation to enhance portfolios, this is tremendously exciting for those members to demonstrate that we can not only achieve societal outcomes and societal gains, but just as importantly, enhance their own portfolio concurrently.
Well, thank you very much, Evan Greenfield.